So good afternoon, everyone, and welcome to the last of a two-part banking bootcamp webinar series brought to you by Fireblocks and Innovate Finance. These sessions are designed to cut through the noise and give you the knowledge, frameworks, and regulatory clarity you need to move confidently into digital assets. In this session, we will break down the four highest impact use cases emerging in the UK market right now: stablecoin payments, tokenized deposits, digital asset brokerage, and securities tokenization, and give you a practical, honest view of what it actually takes to build and operate each one within your existing systems. I'm Hayley Sedgwick, COO of Innovate Finance, and I'm delighted to be joined today by John Hallahan, Director of Business Solutions and Advisory EMEA at Fireblocks. John will be providing a brief presentation before we dive into questions. So if you have any questions for John during the session, then please just post them in the Q&A box on your screen, and we will do our best to get them answered. So without further ado, happy to hand over to you, John.
Thank you very much, Hayley, and great to be on with you again.
Yeah.
So I'm just going to share the slides now, and then we'll get straight into it. Ooh, whoops, 1 second, sorry. Let me know when we can see.
Yes, perfect.
Amazing. So what I want to cover today is basically just 3 points, right? So point number one is just to give a sense of, what we're seeing in the market overall. So what are some of the trends that we're seeing, I guess, that are, bringing us here today? I think point number two that we want to cover specifically is around what are the different kind of key use cases, which we're going to talk about specifically in the Q&A segment. And then just to give a sense of what we're seeing, I guess, banks and different firms who are building in the space doing at a high level. So I guess as we covered in the previous session, we're at a really interesting stage now in the industry, specifically around, banks and different types of financial services and fintech firms who are moving into the space. So we pretty much have three key drivers in the market that are essentially pushing us to this position. So the first one is around regulatory clarity. So, we're probably going to speak a little bit about regulation today, but I think, regulation and clarity around where banks and financial services firms can play, I think is really key. So we've seen regulatory clarity in the US, we've seen it in the EU. We now have clarity around what's going to be included in the UK regulation as we move into next year, which I think is great and gives a lot of banks, payments firms, fintech firms a very clear framework within which to play. So I think, we're going to see lots of activity in the UK market. I think that's very welcome. I think the second piece is around the market traction. So I think what we see now is a lot of the transactions around digital assets are starting to gain some really significant scale. So if we see monthly stablecoin transactions, if we see the amount of crypto which is custodied, it's now becoming a really big asset class. And if we think about the fact that we're now seeing types of securities like money market funds gaining really big traction in market cap, I think it's a really good example that we're getting away from these speculative use cases. And I think, that's a great space to be in for people in the space. And then I think thirdly is we've got this really interesting competitive movement, which we covered in the previous session, which is we don't just have, banks and incumbent banks in this space, but we almost have three sides which are coming together and competing this, creating this really competitive dynamic. The first side of that is that we have, the GSIBs and DSIBs and digital banks like Revolut who are really innovating and delivering services really quickly. The second kind of area that we have is payments companies and PSPs like, Stripe and others who are now getting closer and closer into the domain of kind of banking. So you're seeing some of them even getting bank licenses in the US, for example. And then on the other side, you've got what we'd call the more crypto native players like the crypto exchanges, the market makers, the OTC desks, the Coinbases and the Krakens who are more and more getting into, traditional securities and financial markets. So, that competitive dynamic, I think, means a really good thing for consumers, but maybe not an amazing thing for incumbent banks because you need to move quite quickly in the space, which I think is an interesting point. If we move on to it, so there's lots of use cases that we're seeing in the market, right? And you'll see new use cases cropping up on nearly a weekly basis at the moment. But if we really break it down, there's 4 use cases which banks are really trying to solve and to deliver for. So the first one is around asset custody. So whether that's a retail facing app like Revolut providing crypto and different types of assets, whether that is a big custodian like BNY Mellon offering crypto custody to institutional clients, really that's around kind of asset custody and safekeeping as the initial use case. The second one is around what we call kind of digital money transaction banking. So that's either stablecoins or tokenized deposits being used for payments use cases. If you take the payments market, the majority of transactions in the payments domain are issued and authorized by banks. So, banks stepping into space makes a lot of sense. I think, they have a bit of catching up to do maybe on a couple of areas versus the fintech providers. The third one's around trading and brokerage. I think trading and brokerage is a really interesting area at the moment. We have, lots of crypto native firms who've been very active in this space, but maybe banks who haven't stepped into it. So I think it's a big area that we're going to see growth over the next couple of years. And then the last one is around securities tokenization or asset tokenization, which is, all of these money market funds and securities and other types of assets, how they're becoming on the blockchain and how they're solving for things like, collateral mobility and other types of use cases, which are problem areas, I would say, or kind of friction points in traditional financial services. And then maybe just kind of one further point before we jump into the Q&A specifically around it is that we have this concept in Fireblocks of building, or we kind of have this recommendation for banks who are building in this space to think about your digital asset infrastructure as a foundational capability. And what you'll see here on the slide essentially is you have, your custody infrastructure or your digital asset infrastructure as a horizontal, and you essentially build a flexible enough infrastructure that enables you to deliver different use cases through different divisions of the bank. So if we take the example on the slide, you might configure in such a way that your transaction bank can issue digital money. So that would be maybe a tokenized deposit. So that's a very specific setup you can have. You might want to get into the space of offering brokerage services like we talked about the other use case. So maybe then that would go via your investment bank or your markets division, depending on what type of a bank you are. And then you might think about something like actually issuing your own asset, like a money market fund, and that would go via the markets division. So the recommendation that we're making and what we're seeing more and more from banks in the space is they're building this kind of core infrastructure, which they're not going to have to re-platform, and that will be able to basically build all the use cases on top that kind of covers their roadmap. And we think that's kind of the best in class way that people are looking at it. And I think the way that banks can be very nimble and agile and kind of go between different use cases as these competitive dynamics are kind of taking off. So, just a few slides to kind of give a sense of where we see the market, what the use cases are, and looking forward to get into some of the discussion points now.
Great. And that was a really great introduction to obviously what we'll be discussing. And I've got plenty of questions for you. But please, as mentioned at the beginning, do send your questions into the Q&A box, and I will do my best to get John to answer them. So if we talk a little bit about strategy and adoption then, as I guess the first piece to ask around. So which of the four use cases, so stablecoin payments, tokenized deposits, digital asset brokerage, or tokenized securities, is gaining the most traction in the UK, and what do you think is driving that adoption at the moment?
Yeah, so I think if you look at the public facing use cases that are available in the market, I think it'd be fair to say across the four, for the incumbent banks anyway, the tokenized deposits is the use case which is public and is being tested in the market. So we have the GBTD project where a number of the banks have come together to test tokenized deposits. I think that's a really good example of a use case which is defensive in nature. So banks obviously at a very basic level they take in deposits and they lend out money. So if there's any impact around these fintech and crypto providers that are impacting your deposit safety as a bank, I think you need to launch a use case which is in that domain. So I think that's kind of the primary use case that we see from the banks. I think what the regulatory clarity that we've gotten over the last couple of weeks as well, gives some really key guidelines around the other use cases across the four that I've mentioned in the first part. So we expect to see stablecoins over the course of the next year be launched in the market. So fully expecting while banks are focused on tokenized deposits, stablecoins typically are focused on different use cases of tokenized deposits. So you can look at tokenized deposits as more of an internal or interbank use case versus stablecoins, which by their nature are more open. So, the asset can be, freely moving across different banks and across the ecosystem. I think as well, if you look at the brokerage and the trading use case, Revolut's a great example of a bank that's already doing that use case. Obviously just got their banking license in the UK. So, they're probably one of the great examples globally of a scaled crypto trading and brokerage platform. So, I think that's also another one which is very popular, but we haven't seen as of yet any of the traditional banks step into that space. But given that, banks like Barclays and NatWest and, HSBC have very big markets divisions, you would expect them to be moving into that space as well. So a bit of competition there for Revolut, you would imagine. And then when it comes to securities issuance, we have the Digital Guild project, which HSBC's Orion platform has been chosen for. And I think that's a very good example of, an industry-led initiative, which is looking at issuing an asset. And then I think if you look at what's happening in the US with the DTCC pilot around tokenized T-bills, maybe the Digital Guild project then is a very good opportunity for banks and different ecosystem participants to come together to test out some of those collateral use cases that I mentioned. So I'd say all four are being done across the board. But if I was to pick one of the four that's the most popular, I would say it's the tokenized deposit case.
Yeah. I think that resonates as well with what we're seeing amongst our members. So talking a little bit about tokenized deposits and then stable coins, which is what you also mentioned. So what would you say are the key operational and regulatory differences between stable coins and tokenized deposits, and when is each the better solution?
Yeah, sure. I think from an operational standpoint, the way that I'd look at it is a tokenized deposit uh, is held on an allowable basis or like an allow list basis, and a stable coin is probably held on a deny basis. And let me unpack what I mean by that. So for you to hold a tokenized deposit from, let's say, HSBC, for example, you need to be an onboarded customer of HSBC. So there's a KYC requirement to onboard with the bank, and the bank is basically tracking for the wallet that you have, whether they've issued it or you have it yourself, that your wallet is permitted to hold that asset. So that's more of what we'd call like an allow list basis. So from an operational standpoint, it's a little bit more controlled. You're controlling exactly who holds the asset. You can decide what they do with it. You maybe put them in the direction of certain use cases. And from a regulatory basis, in many markets, a tokenized deposit is just another version of a deposit, so there's no specific regulation around it. Whereas if you take a stable coin, by their nature, stable coins are more open. The goal of stable coins is to freely pass between different participants in the market. So when many banks are launching stablecoins, they do so on what we call a deny list basis. And essentially that means it's pretty much the opposite of tokenized deposit. You have a list of wallets who are sanctioned or who can't hold the asset, and you allow it to transfer more freely. And really your customers can, they can use it for different means and different use cases across the board. So that would be the main difference that I see. Another kind of key point is that tokenized deposits are probably more likely to be used in capital markets transactions. So commercial bank money is probably going to be more likely to be used for, say, the settlement of tokenized assets. So if a digital gilt is issued in the program, it's most likely that a tokenized deposit will be used to settle, for example. Whereas stablecoins are more likely to be used in more crypto native transactions. So you might be using it to purchase crypto, or you might use it to deposit into a DeFi protocol to gain yield, for example. So, for most banks, what we recommend is having a holistic strategy around what are the use cases that you want to deliver. So do you want to do cross-border payments? Do you want to allow customers to purchase assets? Do you want to provide FX? And then based on those use cases, map whether it makes more sense to use a stable coin or to use a tokenized deposit. And in many cases, they'll find after they've done that they need both. So what we're recommending for banks from like an operational setup perspective is to have the flexibility to do both, but most are starting with one or another in terms of the setup.
And so obviously you spoke a bit about tokenized deposits just being another form of say, deposit. So focusing on stable coins then. So what challenges have you seen institutions face when they're integrating stablecoin payments within existing payment infrastructure and their treasury
Mhm.
operations? Yeah, maybe a few examples of that you've seen.
Yeah, sure. Absolutely. I think it's fair to say that the hard part in these projects is not about the stablecoin or not about the blockchain-based element, which many people might think that that's the issue. The issue really is integrating core systems with digital assets because the nature of both are quite different.
Mm.
So if you take traditional core banking or payment systems, they have batching of transactions, they have cutoffs from a time basis. There's some level of reversibility around transactions. So if you take like a card transaction that goes through a card scheme, that can be reversed potentially for things like fraud. Whereas if you take digital assets, there's like a certain finality around blockchain settlement. So it's 24/7 by nature, it's continuous, it's on a per transaction basis. So that makes things like reconciling your traditional systems to the stablecoin ecosystem or the blockchain quite a difficult project. So many times that 24/7 basis is a challenge. So where we see the integration challenges is kind of mapping the more real-time system to one which is maybe not as real time in nature. So a lot of these projects are around how you integrate, and I think that's a challenge for many banks and different types of firms who are basically building it. The second thing, which is very different, is that the way compliance is done in an on-chain world versus in traditional is a little bit different as well, right? So you have these bespoke providers like Chainalysis, Elliptic, TRM Labs, who are providing services around what's not KYC, but KYT, so know your transaction. And those things also have to be integrated into risk scoring systems that the bank will traditionally have as well. So quite a lot of work to done around quite a lot of work to be done around the integration side. And I think that's probably the biggest piece where it's we see projects kind of falling down.
Okay. And so talking about tokenized deposits then and stable coins together, what role do you see tokenized deposits playing alongside regulated stable coins, say, over the next 3 to 5 years?
Yeah, sure. I think there's going to be, as I mentioned in one of the previous answers, there's going to be this coexistence between both.
Mm.
So there's not going to be one which is like a winner, but we expect tokenized deposits to become the institutional workhorse, if you will, for transactions between banks, for intercompany transactions, for kind of intra-bank stuff, which we think is really interesting. And you can already see the largest global banks processing very large amounts of tokenized deposits. So if you take JP Morgan and Citibank, processing billions on a daily basis in their tokenized deposit systems. Whereas if you think about the stablecoin ecosystem, that's more of an open network play. So things like e-commerce transactions, things like cross-border retail payments, things like remittances. So if you take companies like Western Union and MoneyGram, they're focusing very much on those plays. So naturally, then for the bank, you'll see this kind of decision based on the use case where you're going to play. And I think for many banks, stable coins are the pressure that's forcing them to focus on the tokenized deposits
Yeah.
use cases. So I'd expect over the next 5 years, banks will have a play around stable coins and also a play around tokenized deposits. And that competitive stake, I think, is good for customers of the bank, but also for other people that are existing in the ecosystem as well.
Great. So if we talk a little bit about kind of the next pillar, then this digital asset brokerage. So for
Yeah.
institutions launching digital asset brokerage services, what are the biggest compliance, custody, and customer protection challenges you're seeing?
Sure. So I think one requirement is around segregation of assets. So I think
Mm.
that's definitely that's a big one. So if banks are launching this use case, ensuring that you can segregate client assets from your own assets, having clarity on who owns the keys over the wallets that are held, if you're doing it on behalf of different customers, and also around how insolvency works. So to make sure certain setups are bankruptcy remote. So that model that you choose determines that story essentially, and that's very much a product design issue that we're seeing in many different customers. There's also kind of the financial promotion side of it and kind of the consumer duty side. So there's a very high bar on how these products are marketed and sold already in the market. So there's things like risk warnings, there's things like fair value, which are available already in the market. Um, and, lots of firms who are already operating in that space. And then I think, there's two other pieces which I think are really interesting. The first one is around operational protection. So because crypto markets are 24/7, that means that clients have exposures on a 24/7 basis. So, being able to ensure that they can settle or get out of positions is one which, a lot of banks have to take care of from a brokerage perspective. And then there's also this piece around, governance of transactions as well. So who can move the client assets? How do you have approvals around that? What are the limits around what customers can spend? So very much more of a governance question. Um, and, I think consumer protection in this market is mostly, it's an architecture decision. And if infrastructure doesn't give you control, there's no kind of a policy which is going to kind of save you here. So I think that setup is really important as well.
Great. We've got a couple of questions already from some audience members. So, first one, among all the CASPs you've onboarded under Mika, what is the single biggest operational lesson firms only discover after they go live? And if you were designing a Mika compliant digital asset operation from scratch today, which three controls would you implement first to satisfy both regulators and auditor?
Yeah, that's a pretty loaded
Question.
question.
Yeah.
I would
I
say
can
so.
repeat
No,
some of
no,
it
no.
if you
It's
need.
it's it's good. It's good. I'm gonna have my thinking hat on. I think so. Listen, there's because the MiCA regulation has put in place this really specific set of guidelines around how you deliver your services, there's a lot of reporting obligations, firstly, that are available. So I think being set up operationally for that is one thing, right? And you almost have three phases to like the Mika process. So you've got the application process where you really need to understand what your design is, what your architecture is, who are you using. You really need to understand the flow really well. So to actually get the application in. Then you've got this second part, which is around questions that the regulator might ask around the applications, and they'll challenge things like your setup and the people that you're using. So being really comfortable about that as well throughout that process is important. And then the other piece then is once you've got the application, there's reporting obligations around things like DORA, for example, which are included as well. So going through that process, you kind of map out what is required both from an infrastructure basis, so like who's your vendor that you're using and who are your different partners, but also from an operational basis as well about how you do things like reporting and how you kind of manage the business. So there's different stages of that process for customers that we've supported where there's different hurdles. But really the operational setup and then a lot of the reporting requirements are where I think a lot of firms struggle a little bit further down the line. So I think having that set up is really important. We have this kind of an add-on package that we've developed specifically for our customers who are gaining MiCA authorization, which is called the core package, which is around essentially as we're a material outsourcing vendor under DORA, because we're being used as kind of core infrastructure in these projects, what are the kind of some of the pieces that we need to report on that they need to pass to the regulator? So that's obviously been a big learning curve going through that process as well. So lots of learnings, I would say, from the MiCA DORA example that will be applicable to UK-based firms as the regulation comes in next year. So I think it's been an interesting process to go through.
Great. Hope that answers your question. And then just another one. So how would you say, this is around stablecoins now, so how would you
Yeah.
say UK regulators are likely to push ahead compared to the EU in stablecoins? Obviously, there's the Bank of England and others announced a few updates there. I think a remark from this person is they're thinking the UK regulators maybe aren't seeing it as favourably as other jurisdictions. So what are your kind of views on that, and how quickly do you see things evolving and at what pace?
Yeah, I think so not to give regulatory advice, but my opinion on maybe some of the key components are, So pretty much every regulator has taken the viewpoint that you can't pay yield. So if the person asking the question is confirming that, I think that's pretty much a case across the board that's been identified, right? So that's kind of number one. And then different regulators they've taken a viewpoint on both whether a stablecoin is systemic or not. So in the UK, Bank of England for systemic stablecoins versus others which are FCA regulated. And then B, around the deposit basis that you can have. So some regulators have been a little bit more conservative about your backing assets, versus others can say, for example, in the US, that you can have 100% backing assets in like T-bills, for example, which obviously from a yield perspective is better for the issuer. So I think I'd expect some kind of a harmonization over the next number of years. You'll already see that the EU has announced a consultation for V2 of MiCA. So they've already kind of got some feedback on firms that are operating in the space around, different things which would work and maybe things that haven't worked as well. So I'd expect a similar process will happen once the UK regulation comes in. Um, but I think fundamentally, from the scope of services and the types of assets and the way activities are regulated, I think they're quite well aligned across the major markets that we see.
Okay. And what do you think, coming to, I guess, the regulatory outlook, which developments do you think at the moment will have the biggest impact on innovation and companies in the space?
From specific to like the stablecoin use case,
Yeah,
or
yeah,
or
yeah,
or
yeah,
yeah, I think to the point that I raised already, I think there's some kind of a harmonization required across the different regulators, particularly as we get into more non-USD denominated stablecoins. So there'll be big euro-based stablecoins, there'll be big GBP-based stablecoins. I think having a mechanism for how they're treated across different markets, I think is going to be important. So I think regulators working together to focus on that topic, I think is one which is going to be interesting. And one of those components around that is like how you can have the backing assets, how many banks you need to use for the reserves. I think they're all kind of operational pieces that until the stable coins are launched in the market and you see how they go, you can't really get a sense of whether you were a little bit too conservative or not. So
mm,
I think they're kind of the two main pieces from a stablecoin perspective that I'd expect to see over the next couple of years.
great. And then just someone asking, just to give actually a bit more of an overview of actually what in reality a tokenized deposit is. So they're just asking, can you give maybe a hands-on example of a tokenized deposit and how it works, e.g. upon bond tokenized, etc.
Yeah,
Taking it back to
yeah, sure. So yeah, no worries. So I guess if you take like it's kind of a few different forms of money, right? So there's central bank money, which is basically money that's issued by central banks, commercial bank money, and then e-money is basically the different types of money at a broad basis. So deposits are basically commercial bank money. And a tokenized deposit is essentially a blockchain-based version or a tokenized version of the money that's essentially held by a bank in deposits. So if my bank is Starling Bank and I have £1,000 on my Starling Bank account, they might give me access to essentially a tokenized version of that deposit to maybe purchase something on like a marketplace, for example.
Mhm.
So if you take what JP Morgan's done with their JPMD, which is their deposit token or their tokenized deposit, they've created a version of it which is available on Coinbase's blockchain, and that enables you to purchase assets on Coinbase. So it's essentially giving you a way to tokenize assets or to purchase tokenized assets in a more seamless way. So that's kind of one of the big use cases around tokenized deposit. The other one is around moving money between different jurisdictions. So if you take what JP Morgan's also done um, with their kind of tokenized deposit network, they have deposits tokenized in different currencies, and they enable you as a corporate customer to basically move those deposits around in like a 24/7 basis. So instead of using the correspondent banking system to transfer between different countries, which takes, 2, 3, 4 days, they can use this blockchain based version of a deposit to transfer pretty much instantly. So there's kind of two examples versus a stable coin, which can be issued by a non-bank as well. So like a fintech can issue a stable coin. A tokenized deposit can only be issued by a bank because it's basically a deposit that a bank can take in.
Hope that answers your question. I think it was very clear from where I'm sitting. So we just have a couple more questions. I'll go back to some of my questions. But first off, someone is just asking, when an incident occurs, what evidence should firms retain to demonstrate effective governance to regulators if needed?
God, that's a very specific question. I would say most platforms will give you audit log and transaction log based data.
Mm.
So ensuring that you have a copy of, the transactions and the audit logs, that have happened. So things like who's approved the transaction, who signed the transaction. I think that's kind of best practice in terms of the type of information that you keep.
Great. So if we just talk a little bit about operational resilience then, which I think is a kind of key focus for a lot of firms at the moment. What operational and technical factors should firms consider when assessing incidents involving blockchain networks, wallets, and third parties? So I guess a bit off the back of the last question.
Sorry, would you mind repeating that one, if
Yes,
that's
yeah,
okay?
yeah. So, yeah. What operational and technical factors should firms consider when assessing incidents involving blockchain networks and wallets and third parties?
Got it. Perfect. So I think, essentially, when you're looking at what operational and technical factors you consider, I think you need to look at from a blockchain network perspective. Um, you've got your own services, and you basically have the blockchain networks. So the blockchain networks are, they're not essentially managed by you as a counterparty. So you need to understand, essentially that sometimes the networks go down. And there's things like congestion on the blockchains. There's, fee spikes. There's, different pieces that are specific to the blockchains that you can't solve. So I think having a viewpoint around that, I think is important. From a wallet perspective, I think what you need to have really clear is you need to have a ceremony around how you produce the keys that govern the wallets. That's kind of
Mm.
number one. And you need to have a process around how you sign transactions. So that's kind of another piece. And then what you need to do essentially is then map those dependencies to, the client-facing services that you have before the launch, and that any incident which affects your client-facing service, um, you have like an SLA to basically respond to that at a very basic level. So there are some of the kind of operational and technical factors that you should consider around those particular pieces.
Great. And then how should, I guess, off the back of that, institutions design business continuity and disaster recovery plans for services that depend on that public blockchain infrastructure?
Sure. So, to kind of not to labor the point on the blockchains, but I think what you need to have really in mind is that, be honest with yourself when you're building a blockchain based business, is that public blockchains at times can break. So like if Ethereum is down or Solana is down and you have assets there, that's not going to be able to, that's something that you can impact as a vendor. So I think you need to separate what's kind of replicable versus non-replicable. So I think the things that you can control from a BCP and a DR perspective are things like your wallet infrastructure, your backups around your keys, making sure you have access to different kind of node infrastructure to sign transactions, um, and all of the different components around that. And they're kind of the pieces that you can control, which sit on top of the blockchain network. And disaster recovery, like from a blockchain perspective and from a crypto perspective, is fundamentally around the key material. So the private keys that you use to sign transactions. So if you have a way to recover your keys and you have a kind of a process around that, that's the best type of business continuity or disaster recovery that you can have. So a lot of our customers, when they're going through like was mentioned in one of the previous questions, when they're going through their regulatory application, one of the things that they need to prove is that they've had a key ceremony. So that's basically a way to produce the keys for the wallets that they have. And you also need to prove that you have essentially a backup or disaster recovery plan in place to recover those keys should the vendor that you're using go down or should there be an outage, for example. So that key backup is kind of the biggest piece. And that's normally held either by the institution itself or by a third party that can be used to basically perform that service. And then, you know, that's kind of the key piece that you have. So in traditional disaster recovery, you recover the actual systems itself, but in the digital assets world, you recover the keys, and then everything else is kind of replaceable on top of that, right? So as long as you have the keys that govern the wallets and the assets, you've got a good disaster recovery mechanism. So when you're designing the plan, you do it on that basis.
We have a couple more questions.
Hmm.
So the next one, a bit of a broad one around, I guess, the future outlook of stablecoins in the UK.
Hmm.
So, do you think the use cases for stablecoins or blockchain settlements that will take over in the UK market for payment? So, say, a bit like if you go to Malaysia, more people are using USDT as a form of daily payment. Do you see that happening here at some point? And if so, to what level?
Yeah, sure. Like I think what you need to assess when you're kind of building a business in this space is where the use case of a stablecoin makes most sense. So in a lot of markets, I'm not specifically sure about Malaysia, but I know certainly for other markets that we operate in, there might not be faster payment systems. There you might have a currency which is inflationary, so you might want access to USD. So in some of those markets in Latin America and Southeast Asia, stablecoin is a good way to both A, have access to USD, and B, basically have a hedge against inflation. And some markets as well, it's also very useful when you haven't got faster payments. So if you're transferring assets from myself to yourself, Haley, in the UK it's fine because we have faster payments. So we'd be able to make that transfer really easily. But in other markets, you're not going to have that. So, I think you need to assess when you're launching a business in this space, what's the use case and how is it better than the traditional system? And in many cases, that's for things like cross-border payments, where that system of transfer is very inefficient. So that's why the remittance companies like Western Union and others are focused on those use cases. So I think in the UK market, what you need to identify is what are the use cases which make most sense for purchase, or to use rather. And I think it's things like being able to purchase tokenized assets. So whether that's cryptocurrencies or other types of tokenized assets, I think that's the initial use case, which makes a lot of sense. And then if you're transferring money cross borders to someone else, then that's potentially another good use case. So I don't think that stablecoins are going to replace all payments. I think that that's unlikely, right? Because faster payments work really well across many markets, SEPA in the EU, faster payments here. But I think they'll disrupt those flows where it's inefficient and there's kind of pain points in the process.
Great. Thank you. And then just another one. So could you clarify the distinction between securities tokenization and tokenized securities? Do you see them as the same concept, or is there meaningful legal and operational difference in practice?
Yeah, I mean the same thing pretty much. Yeah, so I think just synonyms. I think what's the one distinction in the tokenized securities market, which I think is interesting to maybe call out here, is that you've got the concept of digitally native securities versus digital twins. So maybe just unpack that for 30 seconds. So a digital twin is essentially a token which represents a security which already exists. So many of the projects that you'll see in the space are creating a digital twin. So you have this like traditional record which is held, and then you have the blockchain based record, which can be used to, transfer it more freely, post it as collateral, essentially proving out some of the use case. On the flip side, then you've got a digitally native security, which means that the actual token itself is the record of ownership. So the wallet that that token is held in is the owner of that security. And when we're looking at those use cases, we see those ones as the really interesting ones for things like, automating how you get in and out of the assets. So subscribe and redeem, posting them as collateral, and fundamentally, being able to transfer them easier. So when we talk about, tokenized securities, they're kind of the two big types that we see. And different projects kind of choose based on, I guess, where they are in the maturity curve.
Great. And then just another question that's come through around tokenized deposits. So the utility of a tokenized deposit is strongly limited compared to a stable coin. So essentially they're saying a tokenized deposit sounds like it's a voucher that can be used only within one shop, compared to, say, a stable coin that can be used in all shops. What do you think about the utility of such tokenized deposits? Do they really have a future like this?
Yeah, I think it's a fair point if it's like a single bank tokenized deposit. So,
Mm.
if only Barclays issues a tokenized deposit and I'm a customer of NatWest or or Revolut or Monzo or whoever, that then yeah, that is the case. Maybe that there isn't an efficient system for you to hold that asset. Um, I think though, what's going to make tokenized deposits interesting from a retail basis is how banks can accept the deposits of other institutions in the same way that you can accept, deposits that are held by other banks now. And I think that's why the GBTD project is really interesting, right? Because clearly one of the things that they're focusing on, that the members have been public about, is that it's a mechanism for how the tokenized deposits from the different institutions can interact and they can freely be transferred. And what that means that on the back end, you're kind of settling in central bank money, but then the deposits are more freely flowing. And I think in that ecosystem, a tokenized deposit actually operates a lot more like a stablecoin because most people will be onboarded to one of the larger banks. So I think in that context, there'll be a lot more utility around tokenized deposits. There's also other projects which are in flight around tokenized deposits. There's one which is being led by Swift, which Swift is the large payments and messaging network, which is mainly used by banks. So banks use Swift to basically send messages to each other when they're sending money. So I think that's a really interesting example of a tokenized deposit network as well, because there'll need to be interoperability there between all the different types. And then there's another one called Project Agora, which is being led by the BIS, the Bank of International Settlements. And that's also a really interesting one because naturally the banks will be working together on a standard. So if it's a single bank issue tokenized deposit, I would agree. If it's one which is a more of a consortium based model, I think being open minded about how they might be impacted, I think would be a good suggestion.
Yeah, which I think, yeah, the latter is likely where it will go.
I believe so.
Great. So if we just talk a little bit then about third-party risk, what due diligence criteria should firms use when selecting custodians, wallet providers, tokenization platforms, and other digital asset partners?
Yeah, sure. I think it's a really good question. I think it plays a lot into some of the questions that have been answered around, when you're going through your regulatory application, what are you looking at? I think there's fundamentally four pieces that you should look at. So I think the first one is around control. So what's the control model? So, who controls the assets? Are they a custodial provider or a non-custodial provider? So are you using someone to outsource, or are you basically taking control of the keys and the assets yourself? So I think that's a really important initial question. Many banks in the space we see are taking control themselves over the infrastructure and over the assets. Maybe some smaller providers are outsourcing some of it. So I think that control question, I think as the first one, is really important. So I think you really need to understand whether you want to hold the keys in advance. The second one, I think, when you're looking at a provider like a Fireblocks, is around the security evidence. So do they have independent certifications like their SOC reports? Do they have ISO reports? Are they getting penetration testing done on a regular basis? Do they have like any incidents in the past? So I think, from that basis, those things are really important when you're picking a vendor. The third piece then would be around, I guess, the operational substance around it. So, is the provider, financially resilient? Do they have insurance? Do they have like regular audits, for example, where you can join in? So, for example, if you're regulated under MiCA, for example, you might want to audit your service provider, and I think that will be a similar position that'll be taken by many people in the UK. And then I think the last one is around exit strategy. So, do you have basically a mechanism to move to another vendor? Can you extract the keys? Can you operate it independently of yourself? Because I think that's a really key regulatory requirement which comes out in many of those. So I think there are four different dimensions that you can look at around that piece.
Very helpful. Thank you. I've got a few more questions that come in. So if I take the first one. So how do your clients handle high-risk wallet interactions before assets are released from custody?
How do our clients handle high risk wallet interactions before assets are released from custody? So it depends on, I guess, if they're being transferred in or transferred out. I assume based on the question that it means assets that have been transferred in. So our clients will, most of them will integrate a KYT, so a know your transaction vendor that I mentioned at the start. So a Chainalysis or an Elliptic or Nota Bene. What those vendors do is they risk score transactions that are coming in. So they'll identify based on the data that they have whether the wallet is a high risk wallet. You'll also set a risk tolerance. So a combination of those two will mean that you'll either block the transaction or you'll allow it. If you block it and it's high risk, the way that you typically, the approach that you follow is that you kind of quarantine those funds in a separate wallet. Because the reality is, when someone's transferring an asset to you on the blockchain, you can't block it. That's how the networks work. But what you can do is put the operational rigor around how you freeze funds if they are identified as high risk. And then you come up with a mechanism to basically address that once you've kind of quarantined the funds. So whether that's working with the authorities or whatever the case may be. So that's typically for those high risk transactions how customers they deal with that. A combination of screening and policy, and then dealing with it off the back of it.
Great, thank you. I hope that answers that question. And then another one says, what is the most common operational mistake firms make when moving from sandbox to production?
Good question. I think when you're moving from a pilot to production, the biggest consideration is around the integrations that you have into your kind of core or your legacy systems. So I think making sure that you've got all that mapped out and integrated in advance is probably the biggest piece, because you don't want to launch something which is operating in a silo and doesn't have any kind of interaction with systems that you already have. Particularly if you're a bank or a fintech provider, you've already got systems in place for things like core banking and other types of trading systems. You might have like a Murex or something like that. So I think, making sure that you've got that working and you've got all of the operational processes in place, I think is the biggest piece. Because doing a pilot versus having something in production, both from an integration perspective, but also from an operational perspective, are two very different things. So we see people kind of, come up with challenges or encounter challenges as they're kind of scaling from pilot into production.
Great. Thank you. And then I guess a couple of questions specifically for Fireblocks,
Yeah.
if you will. So one's come through, how does Fireblocks help firms avoid operational bottlenecks as transaction volumes increase? So just a little bit about, your company specifically.
Yeah. So, I mean, we try and be scalable around how many, like the transaction throughput of the platform, basically. So we have lots of payments use cases where there's very large transaction throughput which is required. So we're constantly increasing the elasticity of the system to allow higher TPS. The one thing to note is that like a lot of the bottlenecks that you'll see are not around software vendors like Fireblocks not being able to process transactions. They're around the blockchain and how that processes transactions. So I think being able to identify both of those is an important piece. The second one then is that we come up with kind of new signing algorithms, which basically enable us to sign transactions faster. So we have a new MPC algorithm, which essentially enables you to sign transactions on a much faster basis. So it's a combination of kind of throughput of the system overall, and then also some of the ways that you can kind of increase things like signing.
Great. And then final question from one of the audience members before I throw another couple at you. So how will all of this affect compliance measures as you know it going forward, just in general? Do you think there's more risk attached to the operational rigor?
Yeah, listen, I think it's just it's a different muscle that's being built across the organization. So like a lot of banks and fintech firms already operate very complex compliance departments. They already have things like regulatory obligations, regulatory reporting. So I think it's just ensuring when you're putting in these systems that you're ensuring that you can still tick all the boxes with regard to those pieces, and then that you have the right I guess ecosystem partners in place to ensure that you have those obligations met. So it's kind of a combination of those two things, I would say.
Great. So hopefully that answers all the questions we've had come through. So I guess just a couple of closing ones from me.
Sure.
Obviously, AI is huge at the moment. That we're hearing a lot of it, a lot of our fintech members, obviously in the space. So looking at AI agents and how they're beginning to transact autonomously, do you see today's digital asset infrastructure, so particularly wallets and stablecoins and tokenized deposits, as sufficient to support agentic payments, or are there fundamental capabilities around things like identity, authorization, operational resilience, etc., that still need to be developed?
Yeah, sure. So I think agentic payments is like one of these really popular topics we're seeing at the moment, right? So it's pretty much every discussion that you'll have or every, you know, podcast you listen to kind of has a view on agentic payments.
Mhm.
I think stablecoins in particular, maybe less so tokenized deposits because of their kind of closed loop nature. But I think stablecoins have a really interesting role to play in machine to machine payments. So we've actually launched a product recently called the Agentic Payment Suite. And what that's focusing on essentially is the full life cycle of agent initiated payments using any stablecoin across any of the blockchains that we support, basically. So I think that flexibility is going to be really important. And I think you've got industry initiatives like the X402 Foundation, which are contributing to basically new standards for the agentic payments domain. And pretty much you have kind of two different sides to it. So I think the first one is around the acceptance side. So we call it the agentic payments gateway. And essentially that means that you as a payments company can deploy these agentic wallets to your customer base, and you essentially can make sure that you have institutional controls about things that you've already mentioned, like policy and KYT and travel rule and different pieces. So that's kind of number one. And then on the flip side of that, then you've got the agentic wallets themselves, which are basically how the different people will interact. And what we're seeing is embedded wallets are probably the most popular piece there. So wallets that are embedded in different applications, essentially. So we see it as a really big area. We think stablecoins have a really big role to play. And we're kind of building that capability to enable, payments companies, fintechs, those types of platforms to engage with those agents and have wallets that can basically interact on a more programmatic basis. So that's kind of the key piece that we see. So work to be done on the protocol side and different pieces, but I think from the perspective of us, I think we're very bullish on agentic payments in general.
Yes, as you say, it's a big topic at the moment. We're seeing that. Even did a roundtable this morning on the subject, so
Oh, very, very good.
definitely a popular one. So if you had, some CIOs or CTOs in some of, our fintech organizations or institutions that were a bit skeptical at the moment about investing in digital asset infrastructure, what advice would you give them today?
Yeah, I think probably three things. So I think the first one is get up to speed on what's happening in the market. So I think there's forums like this, but also reports and various different things which are being released. And what's clear is that so the regulation is already here in the UK. There's firms that are already building. So I think the time is kind of now. So I think I'd be really informed. Would be point number one, and kind of get a sense of what's happening in the market. I think number two then is based on being informed, decide two things. I think every company needs to have this as a strategy. Firstly, is where do you play? So, what area makes most sense for you? So, if you're a fintech brokerage platform, maybe you add crypto as an asset class. If you are a payments company, maybe you want to look at some stablecoin flows. If you are, a wealth platform, maybe you want access to different types of tokenized assets. So, knowing where to play is first one. And then secondly is how to win. So I think, what's your position going to be in the space? What's your offering? That's kind of point number two. And then point number three then is kind of start doing something. So whether that's a POC, whether that's a pilot, I think, the best way to learn in the space is by getting your hands dirty. So if you do steps one and steps two, I think really well, you can go very quickly from the step three POC into production quite quickly, depending on the use case. So I think they would be the three step process that I would have, or the mind map for how you can get active in the space.
Great. Well, we're coming to the end of the session now. Is there any kind of final thoughts or things that you would like to share, or anything else that we haven't discussed?
No, I think all good. I think it's a really interesting domain and space. I think thanks a lot again for having us. Hopefully it was useful for all of the attendees. And if anyone wants to talk a little bit in more detail, happy to reach out directly and happy to have a chat on that as well.
Great. Well, thank you, John. I know there was a lot of questions, so appreciate it. You managed to answer all of them. And thank you to everyone for joining us. We hope you found it insightful and valuable. And if you do want to reach out to John or anyone from the Fireblocks teams, then don't hesitate to get in touch with the Innovate Finance team. But thank you and goodbye for now.
Thank you.
Thanks, John.